Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every single day. Well, today we're taking up Action Construction, and this is actually a construction equipment company which, well, essentially looks at cranes. Now, it was established back in 1995, and it was the world's largest pick and carry cranes manufacturer. It also offers other products which would include construction equipment segment. But if you just look at the way the revenue split is for the financial year gone by, you see that about over 70% of the revenues come from cranes, and that's followed by construction equipment at around 13%. And let's not forget, you also have material handling at 7% and agricultural equipment, which stands at around 8%. But majority of it comes from the construction and the selling of cranes. Well, what we usually do in this show is that we take a look at the several parameters for this company to assess it on a fundamental basis. So we talk about the income statement over the past few years. We talk about the balance sheet as well as the cash flow statements. Based on these statements, what kind of return ratios are you looking at? And we move beyond that and take a look at several of the other factors as well. That would include the shareholding, the street credentials, street coverage, as well as the valuation picture, which would give you a better idea about where the company stands at this point in time. So, before I do that, let me get in my colleague Puneet Javeri, who is also going to help us shed more light on this particular company. So, Puneet, welcome and thanks for joining in. Let's start by talking about the revenue and the PAT. Over the last few years, it certainly has done well.
Yeah, definitely. It's the company, of course, is a small cap company and getting there in terms of growth aspects. But over the last 3 to 4 years, specifically post the pandemic, we've seen a strong growth across all parameters in the income statement. Revenue, of course, has grown at the 33% CAGR over the last 3 to 4 years. For FY24, it was roughly about 2,909 crore, and it has continued its momentum over the last 3 quarters. It's already achieved this particular number in the 3 quarters of this year itself. So it's doing very well on the growth aspect. EBITDA on a profitability side has grown at a CAGR of up to 53%, while the overall margins are one of the highest in the segment that it operates in at 16.5%. In the latest quarter of Q3 of FY25, it came at roughly over 18%. And these are some of the stark numbers because, while not a direct competitor, companies like Escorts Kubota operate in the 12 to 13% in terms of EBITDA margins. And profit as well, coming in at 328 crores, has almost tripled over the last 3 to 4 years. So definitely on the income statement side, it has grown steadily, and it's reflected in the numbers as well as sales performance as well.
So there you have it, some very strong revenue numbers as well as your bottom line, of course. And we're looking at reasonably good margins too. So let's move on and talk about the balance sheet. Now at this point in time, it does look like it has a very strong balance sheet. Sure, its net worth it stands at around 24%. That is shareholders' equity. But it does not have any debt, and the it has become debt-free over the last few years, and it has cash in bank of around 64 odd crores. So it's certainly looking like it's a sort of favorable place. And remember that because it's into capital goods, well, I know that this can be categorized in many different ways, but essentially, given the fact that the company actually deals in the manufacturing of cranes, is also the reason why, in many ways, it can be categorized as capital goods. One might expect that there would be a substantial amount of debt on the books, which is not the case, at least as far as this particular company is concerned. In fact, you will have a significantly higher debt even in automaker, an auto manufacturer, but that's not the case for Action Construction. So, of course, the kind of growth that we've seen over the past few years has aided the company in becoming debt-free, which is why we'll give this one a thumbs up as well. But Puneet, then let's talk about cash flows. They look all right as well.
Yeah, definitely. We spoke about the income statement growing at a very steady pace, and that's reflected in the cash flow from operations as well. So it's come in at 433 crores in FY24, and that's grown at a steady CAGR of 71% over the last 3 years. And that's been one of the key positive aspects about this company, that while the revenue has been growing, it has firmly focused on the cash flows as well, and that's reflected in the numbers. While on a net cash flow basis, the company has, degrown in terms of, -3% over the last 3 to 4 years. but it has heavily invested in building up capacities. And while you rightly said, Agam, that it has not taken on as much long-term debt, which has benefited the cash flows as well. So overall, while the net cash flow has been negative, it's expected to do better over the next 2 to 3 years, while the net cash flow from operations has been growing steadily and is expected to continue this momentum as well.
All right. So, moving on from well, your cash flows as well, let's talk about your return ratios, and that will also give you an idea about how things are panning out as far as profitability is concerned, the stability of the returns. And we usually talk about the return on equity, and we talk about the return on capital employed. So when it comes to return on equity, is a very healthy 31%. Remember that any number over the mark of 20-25% is a pretty good return on equity, and that is what Action Construction does have. If you move on and talk about your return on capital employed and you judge it by the same standards, its return on capital employed for the year gone by stands at around 43%. And remember that some of these numbers will resemble those of your staples companies. So this is a pretty good return on capital, return on equity as well as return on capital employed, which is why it's certainly going to be a thumbs up here as well. So if you consider your overall income statement, you consider the balance sheet, the cash flows, as well as your return ratios, it does look like the company is on a very strong footing. Of course, we'll talk to the management a little later on the outlook of the company, but so far it has done very well. And it does seem like it has taken advantage of the, push in infra as far as the nation is concerned. And to a certain extent, we've also seen that demand come through for the company, which is why we've seen such a strong growth rate. So this is as far as your financial statements go. Let's talk about the shareholding then. And okay, so Puneet, why don't you take up this aspect? How do things look here?
Well, definitely, the promoter shareholding has been very stagnant and not a lot of movement there at 65.41%. And that's one of the key positive as well. While foreign institutions own almost 12% in this particular company, we've seen lower ownership by domestic institutions. So specifically, your mutual fund houses, among others, have lower ownership on the company, but the public as a whole have close to roughly about 21% in the company, and it's a well-diversified company in terms of one of the retail, wouldn't call it a retail favorite company, but specifically one which has been in the radar of investors, and that has, propelled the stock, over the last 3 to 4 years as well in terms of share price performance as well. So, Agam, overall, while, promoter holding has been stable, that's one of the key positives. Rest of the factors also don't seem too much of a complaint about Action Construction in the shareholding aspect.
Right. And so now, we're coming to a little bit of a puzzling aspect, and I'll tell you why that's puzzling, is because I talk about the street coverage. And if you consider the Bloomberg consensus, where we don't have anyone who's covering Action Construction, this isn't exactly a small company. It has a market cap at around 15,000 crores, and it has grown from strength to strength, as will be evident, when Puneet talks about the kind of returns that the company has given. But even as you see such companies climb, you tend to see at least sell-side analysts, if not buy-side analysts, initiate coverage. And while we do have a handful of companies, or rather brokerages, cover Action Construction, we haven't seen anything very substantial at this point in time, which is why, and given the fact that after the kind of growth we haven't seen any coverage, we're going to give this aspect a thumbs down for now. But in terms of returns, as I was telling you about, Puneet, certainly a huge multi-bag over the last few years.
Well, definitely. We've taken the 5-year return performance just for comparison, and it's up almost 15 times. It's given 1,550% in terms of stock price performance. It currently trades at around the 1,200 to 1,300 range, and it's fallen from the highs of about 1,600. That's largely because of market performance. But I did just check the lows, Agam, for this particular stock price, and it was around 56 rupees in the COVID time. So from there, it's gone all the way up to roughly about 12 to 1,300. And definitely, if someone held on to the share or got in at that particular point in time, it would have been a big multi-bagger for them. While the dividend yield is not too much to talk about, it's a high growth company. It has been investing heavily in terms of new products, R&D, as well as, increasing the capacity. So wouldn't, take this as a negative. So as to say, while the dividend yield is just 0.16%, for this particular company, there are some other factors to look at. So definitely not a negative. It would be somewhat, not a thumbs up or a neutral as well. But it's just the fact that while the dividend is low, a high growth company, definitely a big positive for Action Construction in terms of business performance. And they've been investing there as well.
Okay. So, that's coming down to the kind of returns that the company is given. It's very evident. It's for everyone to see. Even if you consider the 1-year returns, the returns that you got is positive. The reason why we don't want to consider 1-year returns at this point in time is because the markets in general have taken quite a hit over the last 4 months particularly, and which is why it may not necessarily be fair to especially compare a relatively mid-cap company with the benchmarks, or for that matter, something in the mid-cap, the small-cap company. But I will tell you this, that even on a 1-year basis, it has given you positive returns, even as we see a lot of the other companies reel and under pressure and give you those negative returns. Well, I come down to the aspect of valuations then. And when it comes to that, again, as if you consider the FY24 valuations, based on that, it's coming in at around 46 times. One might say that it does look expensive, but we must also remember that the company has once again shown a tremendous amount of growth in the 9 months gone by. And if you consider that, well, the valuations will be considerably lower, around 30, 35 times. And at this point in time, given the kind of growth that the company has seen, the expectation of the company in terms of growth, well, that would perhaps tend to suggest that the valuations are not unreasonable at this point in time for the company. So which is why we'll give the valuations a neutral stance at the moment, because a lot of the investors are still figuring out what the new normal for valuations is, especially given the kind of correction that we've seen over the past few months. Just want to, Puneet, you want to add a factor here?
Yeah, definitely, because management in Q1, so a couple of quarters ago, had mentioned that they're expecting revenue to grow 3 times in the next 5 years, and I think that's one of the key aspects. And valuation just, of course, comes down dramatically. But we'll quiz that to the management as well once on that aspect of what's the growth aspect going forward. But one of the key aspects to look at, while there's no street coverage to compare with or forward valuations, I think the forward guidance is something that the management has always given and expecting to do well as well going forward.
Well, that remains crucial. So, on that note, I'm going to firstly sum up all the factors that we will put together and give you an overall rating on the company. So we've spoken about the income statement, the balance sheet, the cash flow, the return ratios. It's a thumbs up for all these 4 important parameters. Even if you move beyond that, we are looking at good stability when it comes to shareholding. Of course, street credentials are massive thumbs up because it's been a clear multi-bagger. I'd reckon that it does not have street coverage, so that's one factor which may work against it. But besides that, valuation picture, again, a lot will depend on the outlook. So based on that, it's got a total score of 6.5 out of 8. That's the NDTV Profit rating for the company. Now, moving on, if you just consider very quickly, we have the management standing by to chat with us. But before that, I'll very quickly go through the strengths, weaknesses, opportunities, and threats. So, in terms of strength, of course, it's an integrated player in the crane segment. Given the fact that it has a 63% market share, it does have a dominance in this particular area. And over the past few years, it's built a lot of credibility in its name, against its name as well. So that certainly is a strength. And it crossed the 18% EBITDA margins in the third quarter of FY25. That is the ongoing quarter. That is a quarter just gone by. In terms of weaknesses, again, new segments like agri and machine handling are seeing a little bit of slower growth. And there is, of course, a little bit of slowdown in government ordering. But Puneet, let's talk about opportunities and threats then.
Yeah, very quickly, the new segments we spoke about, the agri and machine handling will be doing very well over the next, 2 to 3 years. So definitely a high growth opportunity there. While new products to be, introduced in the export market, That's something that the company has been mentioning as well, and it's present in the latest presentation as well. And while threats, there's not too much to talk about. Valuations is one of the key things that we discussed at 46 times price to earnings for FY24. And while not a direct competitor, something like an Escorts Kubota, which is a listed player in the tractor space, that is trading at a lower valuation, but the growth aspect is there as well. The growth is much lower compared to Action Construction, while export will have intense competition. But Agam, these are some of the key aspects of strength, weakness, threats, and opportunities, and
Sure.
I think we'll discuss that with the management as well.
Absolutely, absolutely. Well, on that note, let's get in Sorab Agarwal, Executive Director at ACE, that is Action Construction Equipment, who joins us on the show. Sorab, good morning and thanks for joining in. So far, the company has seen a lot of strength, not just in the quarter gone by, in the 9 months gone by, but over the last 5 to 6 years. At this point in time, there is conjecture whether or not there will be saturation in the markets. I know that the government does have a very ambitious outlay in infrastructure. As far as real estate sector is concerned in general as well, there are plenty of projects lined up, which could, of course, take advantage of the construction equipment that you're in. The question now is, based on the last 9 months, the kind of growth that we've seen, what can you tell us about the growth over the next few years? You've given us a guidance that Puneet mentioned as well. Do you still stand by it?
Yeah, good afternoon. We do stand by what we have said, and the way the country is shaping up, the way the infrastructure and the focus of government on manufacturing sector is there apart from infra, and these are the two main domains in which we operate. I see no reason that we should not be able to fulfill the guidance of, let's say, doubling or tripling our revenues, which we've given in the last 2-3 years. So I believe that within this coming next year, as compared to FY23, we should be in a position somewhere to double ourselves. And then about a year back, we had said we'll triple ourselves in the next 5 years. So I think we are on track. We are seeing reasonable traction again back in the infra segment. Manufacturing has been strong, our supply side. So I think on the whole, things are moving in the right direction. Even real estate is chipping in well. That contributes about 10 to 12% to our revenue, apart from infrastructure and manufacturing. So I think on the whole, things seem to be in a decent space as per whatever we had planned for our company.
Mr. Agarwal, good morning and thank you so much for joining us today. It's Puneet this side. I just wanted to understand about your export part as well. That's one aspect that you've been focusing on but hasn't reflected in revenues yet. I just wanted to understand from a medium-term perspective, next 2 to 3 years, what is the kind of potential that you're expecting from revenue in terms of the export market? What percentage? Is it somewhere between 15 to 20%? And do you see it coming from newer categories, or do you see cranes as one of the biggest revenue growth drivers in the export market?
For exports, about 3-4 years back, we had planned that we take it to about 15% contribution within our company, which was at a minuscule 1%. And till last year, we were able to grow it to at about 8% contribution. It has been a little slower this year, owing to a lot of factors, but I'm sure it will catch up. So our medium-term plan is to get to about a 15% contribution from exports, which I'm sure over the next 2-3 years we'll be able to do. And apart from that, around that time, we had also started focusing on the defense business, and we wanted about a 5-6% contribution at least to be coming from defense, which was a possibility. So in the current year, I think we should be doing about 2.5-3% from defense. But for the next year, with orders in pipeline, which we see, I think the contribution can go as high as 5-6% from defense in the next year. So maybe exports and defense coupled together next year can go to 10-12%, maybe slightly more. And our medium long-term target was 20% coupled from defense and exports together. So I think we are on track, and hopefully it should play out well.
Just a follow-up, Mr. Agarwal, in the previous conference call as well as interviews with us, you mentioned that you were looking to set up a new facility in Africa, and I think that was based on some conditions of some outlay. Just wanted an update on that, and do you see defense being more of a localization theme, or would exports also have some kind of defense component revenue as well?
No, defense is purely a localization theme. And in the past 2-3 years, we worked very closely with DRDO on certain types of cranes and equipment which are required for handling and even for some of the missile programs. And we have already successfully supplied some machines also to that extent. and it's a domestic play with respect to defense. And we are on the verge of getting one of our biggest defense orders, and it should have gone through by now, but yes, stuck up in some paperwork. So hopefully, over the next week, 10 days, we should be getting that one of our biggest orders, which will actually help us, achieving 5-6% contribution from defense in the next year, and maybe even the year after that, because we are supposed to deliver it in about 2 years.
Okay. Sorab, just to talk about the near term, and you have spoken about this particular defense order, but even beyond that, the last quarter, is that also a seasonally strong quarter for you when it comes to a higher amount of orders? Is that also the case for your particular company? And going into the next perhaps 3 quarters, what kind of ordering activity can you expect going in?
See, traditionally for our company, the first half, because of monsoons and the construction activity getting a little slower, especially in quarter two. So about the first half is about 40-45% of our revenue. And the second half is 55-60% of our revenue. So definitely quarter three and quarter four are bigger than quarter one and quarter two. And obviously, as it has happened in the last 25-30 years, similar thing has played out again. So second half is much stronger for us. So going forward, I think in the next year, let's say H1 next year, it will definitely be smaller as compared to H2 of next year. And obviously we are going great guns in quarter four every year, and similarly we are going great guns. So hopefully, I think again we are on track for our biggest ever quarter again in the current quarter.
Mr. Agarwal, I just wanted to an update on something that you've spoken previously, as which is your acquisition strategy. You had a couple of acquisitions over the last 2 to 3 years. Any kind of update that you can give on that?
See, somehow we've not been able to conclude anything much. Apart from the joint venture, currently we are in the process of forming with a Japanese company to make bigger cranes. So hopefully that should take shape by end of this quarter or within the next quarter. And but we are actively pursuing and looking at inorganic growth. So hopefully going forward we'll have some good news.
Saurabh, your balance sheet also looks like it's in a very comfortable position at this point in time, considering the growth plans that you have on the anvil, the kind of demand that you have for your equipment and cranes. Do you think that at some point in time in the next 2 to 3 quarters, you would potentially need more funds, or would internal accruals be enough for you to fund all the operations so far?
I think internal accruals will be good enough. And even currently, we have a capacity of 4,500 crores revenue. I mean, within this quarter, it'll be increased to 5,100 crores. So which should be good enough for us for the next 1.5. We are generating good amount of cash. We have close to about 900 crores available with us in the company for future growth. So I see no reason that we should be looking to raise funds or looking towards debt going forward, unless and until something really big turns up in for inorganic or something. So as of now, we really don't have any plans to raise money going forward.
Right.
I think we should be able to manage from internal accruals.
Saurabh, also a question on your focus in defense and of course your exports. Are those businesses, are those segments, what kind of impact can it have on your operating margins? Do you think that they'll help maintain them? Because I believe, that if I'm not mistaken, we've seen the highest operating margins in the quarter gone by. Do you think that there will be some sort of an impact there, a positive or a negative? What can you tell us here?
See, again, our margins with respect to export or defense business are in line with our company margins. So, they would really not be affecting positively or negatively with increase or decrease in contribution of this business. And primarily, we started focusing on these two aspects of the business to make our business a little counter-cyclical, as it was, 5 years, 10 years back. To have certain more revenues from where we can garner business, which can, give stability to the company when cyclicality part plays in. So I think to date, we've been able to do it at a reasonable level. And going forward, as we discussed, we want to increase the contribution from these two segments.
Just one last question, Mr. Agarwal. You had mentioned that a new segment could be the electric segment for you in terms of electric crane. How have you seen the acceptance currently in the market for that kind of a product? And do you see export margins to be higher than the domestic margins going forward, or currently what is the scenario for the same?
See, with respect to the electric crane, we had introduced this crane about more than a year back. Then certain government regulations with respect to CMVR and registrations were not in place. And these have been gazetted in November last year. So, and then obviously then we required CMVR approvals from ARAI. So there again, there is still some more clarity which ARAI requires. So I think we are still at least 2, 3 months away from commercially being able to sell the electric machines in our country due to lack of regulations with respect to CEV, construction equipment vehicles. With respect to traction and acceptance or the excitement around it, I think all the bigger companies, whether in the infra and especially in the manufacturing space, are really bullish and gung-ho on that, and they're waiting for deliveries. To be very frank with you, it's just that going by the legality part of it, we are just playing safe so that when all the regulations are in place with respect to the government, then we should hit the market. So hopefully Q1 next year onward, we should be commercially be able to start deliveries of these machines. We have delivered some machines already, but they are primarily focused on where the registrations are not required. So I think this should start to take shape in the next this thing. There was another part to your question. I missed that, please.
Export margins, is it higher than the domestic play, or is there nothing too much to it, or is there something I'm looking for?
See, they're definitely slightly better, but those machines are also slightly higher spec. So they're definitely slightly better than the domestic margins, yes.
Okay. Okay, Sorab, we leave it at that. Thank you so much for joining us and well, shedding so much more light on the company as well as the prospects of the company as well. Thank you so much.
Yeah, thank you. Bye-bye.
Well, and on that note, that is all that we have on this edition of KYC, and a very interesting company that we've covered. But lots more lined up on the other side. Stay tuned to NDTV Profit.